Hello, everyone. We had to go through another painful week. We started out really great on Monday that hopefully this Iran issue will get resolved. But by the middle of the week, market gave up hopes. And obviously Friday was an extremely painful day for many of us. So we are dealing with headlines every single hour. They're changing and people's sentiments and mood is changing based on those headlines. So I want to talk a little bit about what's happening in the market today. I want to talk about gold and silver and where we think we are going with this. I also want to talk about the liquidity crisis that might be emerging in the market, as well as the housing stocks. So I want to talk about all of that stuff today. Now, those of you guys who don't know me, my name is Deepak. I'm a tax code advisor. You can reach out to me via taxcodeadvisors.com. So if you need some help filing your taxes or need some help with the consultation, you want to learn about finance, join a coaching program, reach out to me via taxcodeadvisors.com. I'm here to help. If you are in Austin market, in Texas market, I am planning on doing a lunch and learn event. So right now I'm certainly planning in Austin, but I might even do it in Dallas and Houston if I can find some good location there. And if you're from Houston, Dallas, please do reach out to me and let me know if you know some good value, somebody who offers great food, and we have plenty of space to talk and network and discuss. So I'm thinking maybe 5-6 hour event where we can talk about finance and what's happening in the market, maybe some things around taxes and whatnot, and do a couple of hours of networking and have a lunch together. So that's the plan for that event. So if you have any ideas in the month of May, please reach out to me via taxcodeadvisors.com. All right. So let's talk about gold and silver first of all, because first time after several weeks, I actually saw a light of hope. Gold have been kind of acting like a Nasdaq stock. It's been going down since the war started. It hit, I think, peak of about 5,600, I want to say, and it's down to almost 4,500. So it's in bear market category right now. In matter of fact, S&P 500 is holding up way better than gold, and same even QQQ is holding up way better than gold as well. But they both are down almost 10%, and gold is down more than 20% at this point. So gold is certainly in bear market, and then certain sectors within the S&P 500 in bear market as well. For example, we already know crypto has already been corrected. A lot of growth stocks has already been corrected. Now, most of the Mag 7s are also in correction territory. Some of them might be actually in bear territory as well. Like, for example, I think Microsoft is beaten up like crazy. And now recently Meta, gosh, it's very painful to see these big tech companies. I mean, usually this is what happens with small caps, but now we're seeing with these Mag 7s as well. So anyhow, first time after several weeks, I saw a line of hope for gold and silver. So that's pretty good. Hopefully, this trend will continue next week, and we'll find out. But despite all the volatility in the market, they both ended up higher this week. So that's pretty good. The main driver of everything that we are seeing in the market is obviously the Iran war, which is creating big swings in the market, sometimes on daily basis, sometimes even on hourly basis, depending upon what President Trump says and what we hear from Iranian officials. Although President Trump says there are none left, but somehow we get that news and market reacts to it. So the risk of a bigger decline is certainly here. We might be looking at the bear market if things continue and President Trump is not able to get things under control. We can see what's happening with the bonds in the market. We are approaching almost 5%. Once that happens, I think market is going to panic big time. And on top of that, because of all this, market is also expecting inflation. And because of that, now market is even pricing in a possibility that there could be a rate hike. And obviously, if that happens, you can imagine how bad that is for President Trump, Republicans, and certainly for their midterm prospects. So I'm hoping that it doesn't really get that bad. Biggest problem right now that we are dealing with is that we're in a situation where it is very difficult, if not impossible, for Feds to increase interest rates. You can see what kind of conversation President Trump and Jerome Powell have been having for last 1 year, because President Trump wants the rate cuts. And if we have inflation, then Feds are simply not in position to increase the rate. Some of the problems in the market that existed even before the war. So we can blame everything on the war, but really war is just simply showing us what was already there. For example, take a look at unemployment. Unemployment people say it's steady. And that's why Jerome Powell has shied away from reducing the interest rates. And he said, well, the other side is inflation. We don't know if inflation going to rise. Well, I can tell you there is some clarity on this situation now. So I'll give you my own example. So I was in Bay Area on Tuesday, and I took an Uber, and the Uber driver used to work for an IT company, and now he's unemployed. So I think he was probably in his late 50s, and now he's driving Uber. And then during my return back to Austin, I met a gentleman who was sitting right next to me in the airplane, and his daughter used to work for Meta, making $300,000. She was laid off last year, but she's not looking for a job. She's just chilling out and waiting to find another opportunity that can pay her another 300,000. So why I'm telling you this story? Well, I'm telling you this story because once you start paying attention to it, you might observe it even in your neighborhood. What is happening is senior people, people who have accepted the reality that in the world of AI, they might not actually have a chance. So they're not waiting around for that job that pays them $200,000, $300,000. They're willing to take another job for $100,000. And then on the other hand, you have younger people, and these folks still have a hope. And obviously, they can certainly learn AI, and they don't want to take a cheaper job. They want to wait and go back into the market and take those $300,000 job. So what I'm saying is that it is possible that our next Fed chair might not actually see the rise in unemployment. Why? Because these younger people might not actually want to be in the labor market. They might want to just sit it out. And the older people, they will leave those $300,000 job and take a $100,000 job, meaning you might have more people employed, but they're just simply not making as much money going forward. So when you get that data, you go like, oh, employment is fine. But underneath the surface, it's not fine. Because who is the guy who buys real estate, who buy stocks, who buy gold, silver? Who are these people? Well, these are the people who have discretionary income. These are the people who can spend some extra money. And if they're making only enough to survive, then guess what? They cannot invest in market. They cannot invest in real estate, and things start to slow down. So that problem existed even before any of this happened. Then private credit market, right? So we have already seen a lot of restriction in private credit. So usually what happens is liquidity problem starts in risky assets, and then it continues to grow and start impacting everybody else as well. So you might be saying, well, risky assets, we're not into that. Well, we might not be into them, but we all become risky at some point. How? Well, once interest rates start to rise, our affordability of things continue to decline. And once it arrives at a certain point, then liquidity simply disappears from the market. Banks don't want to give you money. You cannot borrow money. People start losing job, and things get really, really bad very, very soon. So these problems are piling up. So I'm not saying that we are about to crash tomorrow or anything like that. I'm just pointing out that right now everybody's focused on the war, but these problems are real and they do exist in the market. Let's talk about dollar for a second as well, because right now people are selling crypto, people are selling gold, silver, people are selling stocks. But what people are not selling is actually dollars. They're buying dollars. Why is that? Well, people are buying dollar because they're just not sure. They don't know how things are going to work out. So they're just waiting. But I want to point out something. Let's fast forward a couple of months for a second, and let's see how the new world will look like. Or maybe you don't really care about the world, but at least let's talk about the US. Do you think US will have more deficit in next couple of months than what we have today? What do you think about our budget? Do you think we will have a balanced budget, or do you think we'll end up spending more money than what is already allocated in the budget? What do you think about inflation? Do you think inflation will increase or decrease? And I think you know the answer to all of those questions. You do know we are going to have more deficit. You do know we're going to spend more money, and you do know that inflation is going to rise. So if you do agree with that statement, then it's obvious that dollars should be weaker. What does weak dollar means? Well, it means two things. Number one, it's good for international market. That means all of a sudden, you will see a repeat of what we saw last year. That means the international stocks tend to outperform the United States because of weak dollar. So that's number one. And number two is gold and silver. We'll continue to see them rising once people start to realize that these problems are real. Right now, people are ignoring them. Just a matter of time before the market understand that all of this is going to translate into inflation. President Trump might be forced to do a massive money printing. And all of that is bullish for gold and silver. Now, remember, don't go crazy and make some crazy moves right now because of a few things. Number one, this market is driven by headlines, and headlines can change on a moment's notice. So you might go out there and make a move by selling something, and next minute President Trump announced something or Iran announced something, and the market reverses. So know that for sure. If you think that you're smart enough to make an adjustment, then I want to remind you that timing the market is extremely difficult. Like, for example, if you don't time the market and just stay still, most likely S&P 500 on average returns about 12 to 13%. But if you just miss 10 days out of the market, just 10 days, everything else remains as it is. That means you're able to do whatever you want to do, but just for those 10 days you're in and out of market. If that happens, your return for the year turns from positive 13% to, I think, negative 10% or something like that. I don't have exact numbers in front of me, but it's a big difference. So the difference between making a money or not making money is really staying still and letting this fog of war to kind of settle. Another thing is obviously the market is starting to give up hope that there will be a peaceful resolution. In matter of fact, if you look at the market is just saying, you know what, let's just get over with it. If you want to go attack Iran, go for it. But let's get that straight open ASAP. So whatever it takes, you want to go put some big bombs out there, do whatever you need to do, but just get the straight open. Don't let us go through this for another 1 month. That's what market is really telling at this point to President Trump. So we'll see how things goes on Monday. In matter of fact, I wouldn't be surprised if Trump administration takes a heavy push just over the over the weekend to kind of force Iran to make concessions and come to the table by Monday. Now let's talk about the housing market for a second as well, because I think we were all very excited about the rate cuts, and that's why we saw a lot of stocks that they get benefit from rate cuts were going up, especially the home builders and builder suppliers, as well as all the mortgage related companies. They were all really doing well. And then obviously, since the war has started, they have gone back down. So what's happening there? Well, in January, the 10-year treasury yield was just around 4%. And people were expecting it to fall further, hopefully 3.5%, 3%. But instead of that, because of war-related threats, yields have now moved up towards 4.5%, and people are really worried that if we might even hit 5%. And obviously, even at 4.5%, and if you add 2% or 2.5% of delta on top of it, we're already looking at 6, 7% of mortgage rates. People are not happy with that. And if you want to increase them to 7.5, 8%, obviously market cannot take that at all. This makes mortgages less affordable and obviously weakens the housing demand. See, the US saw very strong housing demand after COVID because the rates were extremely low. Later, higher rates locked by many home buyers into their existing homes because they didn't want to lose that fixed rate mortgage. And that helped new home builders for a while because the existing homeowners didn't want to sell it. And slowly that advantages started to kind of fade away. And we were very hopeful that rates going to continue to decline and home builders will start to go up. But instead, we are giving up hope on that rate cut because of inflation. Now, you can blame it all on the war, but I wouldn't. And let me talk about that for a second. So, as I discussed with you earlier, we already have this issue where people are leaving higher paying jobs for low paying jobs. That's number one. Number two, younger people don't want to accept a lower paying job and they don't care about buying houses. So we have this affordability crisis that is continuing to grow in this country. We have weaker job confidence. That means people who have jobs, they're not sure if they're going to be able to keep the job. And then take a look at consumer confidence. You can see all the numbers for this entire year, and they are in toilet. So you look at all of this stuff and you go like, why would the housing sector actually improve? So at this point, things are actually looking pretty nasty, all signaling that we might see another 5 to 10% correction unless President Trump really acts and delivers something. I think at this time, I don't think just setting up a tweet or posting something online is going to solve the problem. I think market is now really looking for a real solution. Market is getting tired. People of this country are getting tired. And quite honestly, the rest of the world is getting tired because all of a sudden, we are asking everybody in the world to join the war, and world is not ready to do that. But at the same time, the consequences of this war are affecting everyone. Whether they like it or not, they might have to jump in the war anyways. So this is what I'm seeing in the market right now. If you want to debate this, I would strongly urge you to let's have a conversation on our WhatsApp channel. So those of you guys who are not part of WhatsApp, send me a message on taxcodeadvisors.com and I'll be happy to add you to the group. Now, once again, in May, I'll be doing a lot of lunch and learn programs in the state of Texas. So if you're around, then let's talk. And then during summertime, perhaps in June, I will be in Oregon area. So I'll probably do the similar event in Oregon as well. And then, maybe Seattle after that. So those are the areas that I'm looking for. Thank you so much, guys. And I'll see you next time.